Okay, can you hear me up the back? Okay, welcome back to week 7. We're looking at behavioral finance. So I hope some of you, well actually not I hope, I know many of you went to the talk on lithium on Thursday evening. A little bit of a fun fact, if you did manage to make it. Adam Lucas, the speaker, represented Australia in the 2004 Athens Olympics as a swimmer. So a bit of a fun fact there. Okay, today's behavioral finance, and I'd like you to have a look at this slide and read it. So I'm going to ask Antata to tell me what this, can you read what's on the slide? Sorry, no, this one over here. Yeah, in the triangle. A bird in the bush. Have a look at it again. Yeah. Okay, good. Very good. You picked it up. I asked this morning's class. This is obviously a brighter class in the afternoon. They didn't get it. But it's a bird in the bush. Your brain overlooked the second "the" when you're reading it. So that's what I'm going to do today. I'm going to toy with your mind as we go through behavioral finance. And the question I'm going to ask is this: how relevant are emotions in finance? So quite a lot. There's a sense that the unconscious is deeply connected with the way, so ever since Sigmund Freud developed this notion of the unconscious, we've become aware that a lot of our decisions aren't exactly what we think about, but we make decisions on the basis of unconscious motives. And so they manifest through our emotions or through some other non-rational way. So over here you have Hopkins, and this is the boss over here, and Hopkins proposed some kind of a program that he thought would be profitable. And you can see over here, it didn't work out so well for the company. And so his boss tells him, it would appear, Hopkins, that your gut feel was only indigestion. So, in other words, maybe there's a sense over here that your emotions aren't something that you can trust. Or maybe they are. Maybe they are a clue to our deeper feelings. So George Soros is a legendary investor, a billionaire, famous, well, according to some, a socialist, but, you know, in terms of... And his son says, actually, he invests on the basis of... That's him, by the way, with his wife. But he relies on animal instincts, saying the onset of acute pain was often a signal that there was something wrong in my portfolio. So here's this... Literally, there's a famous thing in philosophy saying, are emotions the judgment? And in this case, Soros takes this literally. When he feels something bad, in this case, an actual physical pain, he reacts accordingly. And so there's something to your unconscious in terms of processing emotions, investment information. Colin McLeod, who some of you might have if you're doing psychology, he's deservedly one of the most famous academics in Australia, very well cited, and he makes this point that our emotions shape nearly everything we do, such as the choice of a life partner, and whether, for example, share prices soar or the stock market crashes. Now, in thinking about this today, suddenly over the weekend, it struck me that there's something slightly miscued about this. When we talk about the emotions in this way, we have a sense that it's almost irrational, that somehow if we talk about behavioral finance, we're talking about things that really can't be explained or inexplicable. And essentially what we're thinking is this, the element of this famous Latin phrase that you might, that's a typo, famous Latin phrase, which I won't bother pronouncing, but it says, about matters of taste, there can be no dispute. And you'll come across this sometime in your life. But what I want to point out, something here is quite different. What we're pointing out over here is that your behaviors and your tastes can be quite systematically shaped. So the advances in behavioral finance, if all we did was just document instances of irrationality, that wouldn't be very helpful. But what the science of behavioral finance has identified is that there are ways in which we can accurately anticipate and predict how we might respond to particular situations. It's not quite irrational, at least not quite so unpredictable. And so there's, as I said, there's strong evidence to show human decisions are affected by emotion. And perhaps the most, so this person says, perhaps the most apparent risk is that an emotional understanding of the market could lead investors into more fear than is unrealistic. But how do we get to that emotional understanding of the market? And in particular, if that's the case, how do we manage our emotions? That's something I'll be talking about from this, in this lecture. Now, the other point I want to make is that this course, Behavioral Finance, could easily be taught. In fact, I have taught a Behavioral Finance course over 12 weeks, and I could easily teach it for a whole 26th year. So in giving you just one element, I'm just going to highlight some key aspects of Behavioral Finance. I'll expect you, for your own good, but also for the course, to do a bit of further reading. So the point of this lecture is really to help you guide your way through a lot of the further reading you might do in your own time, to provide a framework to evaluate some of those arguments. So the question is how to imagine one's emotions. So this is the kind of thing I'm talking about over here. It's what's going on over here. This might seem completely irrational. We have, and this is kind of a paradigm example of people talking about emotions overruling reason. We have someone who created a cryptocurrency called a Dogecoin. He intended it as a joke, but somewhat to his surprise, this got taken up, and it ended up being worth $2.4 billion. Now, one way of thinking this is to think that these people are mad. They're irrational. And if they're irrational in that way, that's one possibility. A lot of people would admit this. But that's not very helpful. It also puts you, when you're saying that they're irrational, in some ways it elevates you above them. You think, they must be nuts. I'm clearly not nuts. This could never happen to me. When in fact something similar happens to all of us. All of us are, and this is the point I'm going to drive home, all of us are prey to these kinds of biases. And the question is, why are we prone to these kind of biases? It's not quite as irrational, at least not quite as random and unpredictable as this example stated in this particular way might make it seem. You'll find that the people who invested in this, if you talk to them in other contexts, are just as rational as you and I. So it's some kind of ways in which these things work to show you the ways in which your emotions or your perceptions can be misled. So we talk about this, when you look at this in isolation, you see, this seems clearly wrong. But it turns out that in the context, when you're comparing it with other cryptocurrencies, this begins to take on some of those qualities of those other currencies, and you might see it as an attractive investment. So to illustrate what I mean in a completely different context, we'll talk about something known as the cheerleader effect. This cheerleader effect is this notion that when you have a group of individuals who are in a group and are dressed in some way uniformly, all of them, as a group, they look very attractive, more attractive. They might look attractive individually, but as a group, they look more attractive than if you looked at them as each person. So one way in which airlines take advantage of this is they'll have a policy that when a group of flight attendants are walking across an airport, they'll walk together as a group. Because when they walk together as a group, they make much more of an impression, a favorable impression, than if each of them walked individually together. You get the same thing, I guess, with school uniforms, etc. But the point I'm making is that this could also influence people investing. You see one group of class of investments, cryptocurrencies, you think, that's a positive, and so you begin to evaluate all members of that class positively, and therefore you invest in it. So this notion of comparison is a key one in behavioral finance. You have what kind of comparison? You have this Ebbinghaus illusion. So you see here that when you compare this orange and you look closely around it with all these other circles, it looks very small. If you put a lot of smaller circles around it, it looks much larger, whereas in fact the two of them are just the same. So actually I manipulated them to make it different, to enhance the things. So this is true in real life. Here you have this thing from Jeremy Wong, just in case you had some doubts about whether this is a fun lecture, but it's actually quite real. Jeremy Wong from Wesfarmers, I was tickled when he sent me this email and said, actually use some of this stuff that you learn in, that you taught me in investment analysis, which doesn't surprise me, of course, but I was kind of happy to hear that anyway. And in relation to this, he says, I think you'll be happy here that I still use so many theories you taught me. I was talking negotiating tactics with my manager where I emphasized the importance of being conservative with the proposed savings presented. I explained the client would benchmark upon this proposed figure, which would create problems down the line if the savings figure changed significantly. Really just an application of the anchoring and adjustment heuristic. The term heuristic is simply a rule of thumb. I'll explain what the anchoring and adjustment heuristic is in a while. But as it happens, Wesfarmers is, as I'll explain, still subject to the anchoring, feeling the effects in a negative way of the anchoring adjustment heuristic in another context, in a takeover context that it's currently contemplating. So it's quite a coincidence that he spoke about this particular heuristic. So if you want to learn more about this, it's what I'm talking about is the kind of behaviors. If you're thinking, I've come across this term of a life hack, and apparently a life hack is a way of making your life more efficient by just using some kind of, efficiency shortcuts or whatever. If you wanted that, then this book is a very good one by Richard Thaler, who talks about nudge, how you might improve decisions about health, wealth, and happiness in a way that is easy to follow. So you just nudge it along. If you take certain actions, you'll be automatically doing the right thing to lead to the right outcome or a better outcome for you without making in the easiest way possible. But you can see over here as well that the Royal Commission, it's this notion of behavioral finance is percolating into the popular, well, it's been around for quite some time, but now it's going into regulation. So Commissioner Hayne has applied the concept of behavioral economics to more of the sector. Now, one of the examples that they use is quite remarkably. He said that Haynes recognized that a best interest duty was important. Duties do not always come human bias, particularly when those biases are subconscious, and as a result, broker commissions have to go. Now, to me, this doesn't seem quite, I know what he's trying to get at, but it's actually not quite behavioral finance. This to me seems a straight out problem of economics. If you give people incentives to behave in a particular way, if you give them incentives to sell their company's products, like a commission, then an advisor will recommend the company's products over any other. It's not like it's any big emotional puzzle over here as to what's going on. It's fairly simply, quite straightforwardly explainable. And so that concept, this notion about when we bring into bear emotional or behavioral finance as opposed to just a straightforward common sense reasoning that is or the neoclassical model, is a particular issue for you to. It's not an easy, what is the proper domain of the model is not an easy problem to resolve. But in relation to this, the concept here is that you're not your thoughts. You don't have to be beholden to these particular urges. If you can realize that you're subject to these biases and then simply acknowledge them, then you're much better placed to resist them than simply acting on impulse. So do what you feel right, I guess, is not good advice in all circumstances. Now, that's an interesting point. When is do what you feel right, do what comes right is important. And I'll address that a bit later. But having said that we need to be able to manage our emotions, the question would be, would we be better off without emotions? So would we be better off than a robot? And so here BlackRock has, which is a large fund manager, manages over trillions of dollars worth of assets, says they've decided to rely on robots to make investment decisions rather than on people. So, would we make better decisions if we're emotionless, like things? There's this this is a favorite poem of many people because it's back in the Victorian times, that is Queen Victoria's times, 1895. People had this, keep up the stiff upper lip, the British, and so this was a poem that many people thought was good by Rudyard Kipling. It said, if you can keep your head when losing and blaming when everyone is losing theirs and blaming it on you, if you can meet triumph and disaster and treat these two impostors just the same. In other words, if you can keep an even keel and not be affected by people's emotions and lose and start again at the beginning and never breathe a word about your loss, he goes on to say, and then you'll be a man. This is back in then you'll be a person, I guess you might say now. But is that really the way you want to be? And can you be like that indifferent to other people? Michael Lewis, Dr. Michael Lewis, was a medical student, and then after he graduated, became a doctor in the medical emergency section of the hospital. But he had a fondness for finance, and so in fact, while he was going through his medical school and in the early years of his early training, he ran a fairly successful hedge fund. He'd go back and pore over reports, and he was one of the few people to identify that the housing market was way overvalued, that the prices that people were being charged couldn't be justified by the rents that were coming in, and the market was about to crash. So the question is, what made him different? Other people had the same information, and yet he was the only one able to resist that. It turns out that what we believe happens to be conditioned by what other people believe. So while we like to think of ourselves as independent, the vast majority of us, the very vast majority of us, are not independent. And in a way, that's, for various reasons, that's, in most circumstances, that's a good thing. You believe what other people believe, and what other people believe generally is correct. So it saves you a whole lot of hassle in working out the truth for yourself. So to be able to resist what other people are saying, and in this case, everyone said, oh, the housing market is going up, it won't crash. It took a particular kind of perseverance. It took a particular personality. And it turns out that he had that kind of personality. In fact, I'm not sure whether calling it a defect or a disability is the right phrase in this context. But what he certainly had was a condition, which is Asperger's condition. That is, he didn't relate very well to people. And because he didn't relate very well to people, he was able then to ignore what other people were saying, which didn't help him in a whole lot of other social situations, because he was systematically, if you read The Rosie Project, which is a great novel, you'll be able to, it gives you a good example of the kind of difficulties people with this condition have. So he basically found out later in life that he had Asperger's, and that's why he was able to identify mispriced stocks when everyone else could see the same information but were carried along by the crowd. Now the thing is, would you like to be that kind of a person? Maybe not. He says, my nature is not to have friends. I'm happy in my own head. And he said, even Warren Buffett is too popular for me. I won't ever be a kindly grandfather figure. This bit here, expected return, is often influenced by the crowd. So the sentiment, market sentiment determines. So when you talk about the value of an asset, it's influenced by the price, the net cash flow to the investments, but also by the discount rate. And the discount rate depends on people's overall fear or optimism. If they're fearful, the discount rate will be high and the prices will be low. If they're optimistic, the discount rate will be low and the prices will be high. So in this case over here, people were attributing too low a discount rate to the prices of houses, which is why they were able to be so high. He saw that it was too high to be justified by any reasonable estimate. What is reasonable in hindsight. So the question is, do you really think you want to be like Michael Burry? And this is, David Hume makes the point that ultimately, actually, reason is and ought only to be the slave of the passions, that we actually, there's no way for reason, our motivations are ultimately determined by our emotions, our tastes. That's the... So the key things, awareness and the right approach to emotions can help us navigate the world more helpfully, and I'll give you some, I'll tell you about the kind of emotions, how we can be led astray by some systematic cues in the environment that lead us to behave or believe certain things, which normally are correct, but in certain circumstances can be misleading. So the second bit I want to talk, the larger point I want to make is a notion about a model, the use of different models. In your life, so some of you will, as I said, will do psychology, others of you will come from the humanities. You'll have, invariably, you'll come up with a different model of the world. So someone who's a lawyer looks at the way in a slightly different way to someone who is, say, an accountant or an engineer. This mightn't be obvious in just a normal tick, but over the course of repeated interactions, you'll see that they look at the world quite differently because they're using slightly different models. In economics and finance, then, we have this two competing worldviews, two competing models of the world, which is the rational economic model and the behavioral economic model. To give you an indication of what I mean by model, you see Ray Dalio over here. You remember this example where he made the person responsible for making chicken McNuggets possible? He realized he could understand economies by breaking them down into their component pieces and looking at the relationship between each piece. So he looked at the world through an economic lens. Where you and I might see a chicken, a living thing, a sentient thing, fluffy thing, a cute thing maybe. He didn't see that. He didn't see this. He saw this in the context of the hedge fund. He saw it as the price of a chicken is nothing more than the price of a chick, corn, and the soy meal. And that allowed him then to identify the factors which he needed to hedge to be able to allow the farmers to produce more chickens. Now, there's nothing wrong with that. That's perfectly fine as it goes. But you can see that an excessive look at this, if this is the only model that you have, if this is your only way of looking at this thing, it could lead you to some kind of behaviors that are, shall we put it, suboptimal, in the sense of maybe you start then caging chickens. You don't take into account of the fact that they have other attributes other than their value to us as a meal. So you need more than one model to be able to deal with the chicken, I guess, chicken farming. And so this has some repercussions. When people look at the world in a particular lens, and this is the concern with finance, is that the finance theory, the argument is that in finance we teach you a particular model of the world, we teach you this neoclassical model, and it causes people then to make this kind of an error, to excessively focus on the profit maximizing part without looking into other considerations. So they find that employers, again I've shown you this before, just a reminder, that employees of a large international bank behave on average honestly. So in their normal context, in their normal personas as parents, members of the family, brothers, sisters, whatever, they behave honestly. But when they assume their identity as a bank employee, when they think, oh, now I'm a banker, they begin to behave, a significant proportion of them behave dishonestly. So I guess when people are talking about business schools need to change, this is the kind of thing that they have in mind, that to teach people there's more than simply one kind of model. So this is the point I'm trying to make, is that you need a model, you need different models, but you can have more than one. There's no need to rely excessively on one, and simple-mindedness is in having basically too few models of the world to deal with. One argument that's persistently made by people such as Ross Gittins is that economists do this. They have an excessively simple-minded model. So neoclassical economists have this, and they do this, he says, because it makes it easy for the analysis. It's mathematically more tractable. what it's talking about is this notion over here. You see this descriptively spare model. So you have this neoclassical finance model, and we have investors are maximizing return whilst minimizing risk, and that they're rational and unbiased in evaluating and acting on information. This seems a cartoon model, it's a skeletal model. It clearly can't describe everything. A better model, a much more descriptively rich model, is behavioral finance, which combines psychology and economics to explain investor behavior. It's much more descriptively detailed. Now, on the face of it, you would think, this must dominate this model. A descriptively rich model must be better than a simple model, than a more parsimonious model in explaining the world. But it turns out actually, no. There are some people, some of them my colleagues, my eminent colleagues in the economics department, who think, really, economics should be about this. And with this, we can explain far more things. The kinds of things that we can explain in behavioral finance are fairly trivial. They might explain some things, but they're not really the main aim of the game. The main game is best explained by neoclassical finance. So this notion of different models is, I want to talk about why we can use different models, and we don't have to pick one or the other. So on last week, I was asked for my opinion on the federal budget, and so what I said is the tax cuts were useful. They'll offer significant relief to middle-income tax earners. It increases the incentives to stay in the workforce and also makes up for the puzzling lack of wage growth. And I said there are benefits in flattening the tax rates because that gives people incentives to stay in the workforce rather than to leave the workforce. Now, that's all fine, but it's this kind of an argument, which is fairly standard, is often used to justify lowering the tax rates. But in fact, and so I don't think it's wrong. It increases people's incentives to work, but I wouldn't rely on this as the only reason for decreasing the tax rates, or for the only consideration in setting the tax rates. There are a whole lot of other things that have to be taken into account. To give you an example, though, where just to show you where there's more to tax. So you have that in Denmark, the term tax is a term of affection. So in fact, when you might call your family your treasure, there they call the tax department the treasure, or the tax's treasure. And to have a look at the tax take, it's not as though they have big tax, they have low taxes. They have 53%, Finland 52%, Denmark 51%, Sweden 50%. And Australia takes in, which is just, it's 35%. Tax is fairly new, by the way, something that I found out at the turn of the last century, back 100 years ago, the tax rate was 0. So, kind of surprising. Tax is a fairly new thing. But it also shows that the Nordic nations often top the list of economic indicators. They make up 4 of the top 12 on global competitiveness. So clearly there's more to the tax debate than simply lowering taxes always leads to a good time or a better things. So my point being, you need different models. As I said, my colleagues will often think that this behavioral finance explains the trivial kind of stuff, and this is the kind of thing where they're talking about. So here you have the situation where you have, this is something, a market I wouldn't have thought existed before I read about it. And there are people who get paid by other people to spend their money and to dominate them. So Michael Schaeffer has been seeking out financial dominatrixes since he was roughly 18. The agreement allows him to perform a role he can't always pursue in his personal life, a submissive. There's nothing in your economics that will ever explain this. So you need another model. The question here is, how relevant are these kind of considerations in other life? So my colleagues in the economics department and neoclassical would say, well, yeah, this is the kind of thing which psychology can help you. But really, how many people are like this? Most people don't give their money to others to spend. Most people don't want to be dominated. So it's a relatively trivial part of So that's the reach of the behavioral finance perspective is what we have in mind, is what is contested. So two of the Nobel Prize winners, Eugene Fama and Richard Thaler, he's a champion of rational theory. Richard Thaler, they're quite good friends, but they have different perspectives. So he says, in the not too distant future, there won't be any behavioral finance because everyone will think it's so obvious. Finance will mean behavioral finance. So there's no need to have the word behavioral because all finance will be behavioral. On the other hand, Eugene Fama says, and this is close to 15 years ago, but he hasn't changed his mind. He says, they haven't really established anything in more than 20 years. And now he might update this by saying in more than 35 years. It's not going to... he thinks it's a fairly trivial part of theory, or it deals with fairly trivial aspects of what economics is about. So, because most people tend to think behavioral finance is the way to go rather than the simple model, I'll try to give the argument in favor of the neoclassical model. And the point I want to make here is quite simple, is that counterintuitively, if you're explaining a complex phenomenon, you actually want a simple model. You don't match the complexity in your model. So the more complex the phenomenon, the more simple the model is to explain it. And it's not easy, though, to identify the domain, but let me give you one example of this. Say we're looking at the preference for boys or girls in a society. So this is a few years back. There was someone who invented this method for people to decide the gender of their child, and his name was Erik Erikson or something like that. And there was a huge uproar because people said, if you do that, boys will be chosen. There'll be too many boys born. So people will choose boys rather than girls. And he was a bit of a misogynist, so he thought, well, so what? This is a way to give people choice. And so there's a huge uproar. But later on, coming up now to the present, they looked at the data and they found, so how would you explain this preference? You would think it's got nothing to do with economics, it's due to ingrained cultural preferences. But it turns out that if you look at the latest data, you find that in not all the countries, but in a significant portion of countries, far more than you would expect, there's a huge preference for women. So girls. So when couples asked to choose the sex of their child, they said, yeah, we want to have a child, and we want it to be a girl, by a ratio of 2 to 1. And so people were a bit surprised and said, why is this? They said, the clients on the other side looked a bit surprised themselves and said, well, it's easy. Girls are easier to raise. You have less hassle, they all think. So the point being, this was an economic explanation. They weren't doing anything, so you can think of this in terms of an economic explanation. Boys are easier to raise than girls. Of course, what's easier to raise is nothing at all, and that's a choice that people are making as well. So so an ideologue is one person overuses one kind of a model, and so we have so Alan Greenspan is he was using this model about looking at the self-interest of institutions, expecting them to self-regulate, but he found out they were lending money to these people even though they couldn't repay it, despite their self-interest. So clearly that model wasn't working for him. So what I want to do in this, I've distinguished between the neoclassical and behavioral models of behavior. I want to now to illustrate and explain aspects of the behavioral model, and then to discuss the scope of behavioral models and where they work best. So I want you to think about this in terms, I mentioned the class this morning. I think this is a good question, exam question. There's a hint, if ever there was one. So I want you to be able to critically evaluate claims about both behavioral and classical finance. So the difference then is classical finance assumes investors exhibit consistent preferences and evaluate information without bias. And the point here is that for the most part that works. That is a reasonably good approximation of what happens in reality. Behavioral finance doesn't. Behavioral finance assumes that people, when they process information, use shortcuts. They have mental shortcuts in place that allow them to cope with the limited capacity and information, the limited brain power, basically. And this is a function of the way people have evolved. If you think of your brain as a computer, you're presented with a whole array of information. Every time you have to make a decision, you have to go through all of the variables and decide, it becomes computationally very intensive. And your brain overheats. But if you realize after some time, and nature does this for you, that there are some associations. So typically it'll be that if X, then Y. And then you think, rather than doing all the complications that leads me to prove that X comes and then Y follows, you can just assume if X, then Y. Now, sometimes Y won't always follow from X. Right? I mean, it does in the alphabet, but in what I'm talking about is a variable. So when that doesn't happen, that's when you run into trouble. But the point is, in our evolution, in the natural settings, these heuristics work effectively. In unusual settings, the shortcut, the stereotype. So what I'm talking about is a stereotype. Now, all your life you've been hearing stereotypes are bad, don't judge people by stereotypes, etc. What I'm saying is that in certain contexts, stereotypes are good. In fact, your brain works on the basis of these stereotypes. If we didn't have these stereotypes, your brain would cease to be as useful as it is. And that is true that you need to exercise some caution, which is what... so the stereotypes won't always hold true, but a lot of times they do hold true. So in an unusual context where this stereotype doesn't work, so in a financial market, that's one setting for which our brains haven't been adapted, and so the potential for mistakes is large. So what I mean by a heuristic, shortcuts, have a look at this. Which one is the same? Which one is the biggest soldier? It's that one. Now, there's a part of your brain that tells you, no, it's not that one. They're all the same size. But there's another part of your brain telling you, but that's the bigger one, right? Your animal instinct is telling you, this is the bigger one. Because you're seeing these parallel lines, and your brain has developed this shortcut that tells you when you see parallel lines of the distance, it means that they're receding, they're far away. So an object that appears large in relation to a converging parallel line must be bigger. And for the most part, that is true. Again, this is, which one appears longer? That one there. All right, the top one appears longer. So your brain's telling you the top one appears longer, right? Unless there's something wrong with your brain. Which square is darker, A or B? Now, do this trick if you printed it out. This is actually, they're the same shade. Hard to believe, but they're the same. It's only because you've got that shade up there that makes it look a bit bigger. Am I pulling a leg, or is it true? Check it out. It's the checker shadow illusion. So, framing. How are we influenced or misled? Now, this one is, I think, the most, for my money, this is the biggest and the most important heuristic or bias that we have. This is good in so many contexts. that I think if there's one thing heuristic you should learn, it's this one. How we are influenced by context, the way information is presented. And it's got different elements to this as well, because this isn't just about financial information, but it presents itself in other contexts. So, but let me show you in terms of your choices. Now think about emotions, right? Think about your emotions and how you're influenced to make choices. And so you think about what is rational and what isn't rational. So Australia's preparing for a rare disease expected to kill 600 people. 2 medical programs are proposed. Which would you favour, given these estimates of the consequences of the programs? If program A is adopted, 400 people will die. If program B is adopted, there's a 1/3 probability that no persons will die, 2/3 probability that 600 people will die. So which one would you pick? Look, don't think about it, just say. Okay. Go with your gut. I'd pick B. No? Yeah, right. Frame 2. If program C is adopted, 200 people will be saved. If program D is adopted, there's a 1/3 chance that 600 people will be saved and 2/3 probability that no persons will be saved. Which one would you pick? Now, it turns out that the same information presented in different ways is like this. If you pick frame 1, if you present the same information in frame 1, it's chosen by 72% of people and B is chosen by 78%. If you chose frame 2, that's 72% of participants and 28%. Who are you going to vote for? The Labor Party, the Liberal Party, or the Greens? The Labor Party will give you X tax cuts, the Liberal Party will give you Y. The Greens Party, they'll tax you more. Okay. The point being, if your choice can be influenced by this, you can see that your choices, just by the way the information is presented, it has a big impact. It's kind of a little bit alarming. So this point here is that if the heuristics are hardwired in our brain, your awareness will be insufficient to counteract the effects. So this is not so much your emotions. I mean, this is your emotions, but it's the way your brain is triggered automatically to react this way. You're not being irrational. It's just your brain is working in the way it is to bring up these preferences for or against. So which means that you may have to manipulate the context to ensure that you're not misled. So information ought to be presented in a way that you're not biased unwittingly. The question is, how do we know the likely sources of bias? Before we get to that, I want to go back to this point about framing. And here I want to talk about failure, which people often talk about failure. This is a big, when you graduate, someone will say you should take risks and fail. Failure is good for you. This isn't about that. Although that is probably true, but not in investments analysis. But I'll just, because we don't have time, I'll talk about the 2 people here, Matt Biondi and Michael Chaney. Michael Chaney is the former Chancellor of UWA and former Chairman of NAB and former Head of Wesfarmers and current Chairman of Wesfarmers. And he came to UWA and did a geology degree. So back in those days, when he had a good time, so I picked UWA, it's a good university, so a good time as well. And at the end of the first year, he went up, he thought, I'll go and see how I've done. Now, back before the internet, in Winthrop Hall, they used to type up the names of all the grades. So you went to Winthrop Hall, and then you looked up and down and looked at your grades, your name and your grade beside you. If you were it was arranged in descending order. So if you got the top mark, you were placed at the top of the list. And then it went down. So Michael's a tall man, and being an optimistic man, he goes there and he looks up and starts at the top. Did I top the class? No. Okay, so he sets his sights a bit lower, 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 approaches lower, lower. He doesn't find his name there, which is a problem because they weren't so brutal. If you failed, they just didn't print your name out. So while you were ranked, you didn't have your name there. So he goes to his next course, the same, a clean sweep, a complete failure. So his father comes from a prominent family. His father's a federal minister. And eventually he calls his dad. His dad wants to find out, how did it go, son? And he says, I failed. And his father says, those effing socialist lecturers, what would they know? So completely different. Rather than blaming his son, why would his smart son do this? He's blaming the system. He says, they wouldn't know anything. You just knuckle down, study, and you better do better the next time. That happens a lot. Depending on a range of things, including what suburb you come from or whatever, you'll find that people, when they fail, rather than blaming themselves, they'll blame outward circumstances. Now that seems like a bad thing. They're inaccurate in their perceptions. But it actually can be, and this is something else I'll come to, this self-deception, this inaccurate perception of self can be quite productive. Because if you're thinking of yourself as a failure all the time, then every time you have a setback and you think, that confirms I'm a failure, it's going to stop you attempting to better. Last year, when my son was playing soccer, he was playing with another team, obviously, playing against another team, and one of the forwards in the other team kept on getting the ball, and every time, if you're a forward, you don't score every time, so you lose the ball. But every time he did that, he'd fall and say, I'm such an idiot, I lost the ball. It got so bad, I finally went up to him in the break and said, don't beat yourself up, you're actually quite good. But by beating yourself, telling you're a failure, you're going to drop out of the game. You won't like it. It's the same thing, though, with everything. Successful entrepreneurs, they deal with failure by attributing it to the circumstances and then thinking the next time this happens, I can do better. So the quick story with Matt Biondi, going into the 1988 Olympic Games, or thereabouts, he was meant to win 5 gold medals, big fanfare, the hopes of the US. The first race, he came second. He came second to Anthony Nesty from Suriname. And everyone thought, oh my God, he's going to be crushed. And how will he ever get back? But his psychologist said, no, I know him. He's the kind of person who, if he fails, will then think, okay, what happened? What did I do wrong? And how can I improve? So at that point about this context, how you frame things really makes a huge difference, is mud. Okay, on that little sermon, I'll stop, and we'll come back at 5:2. Okay. One of the questions we need to address in behavioral finance is, what is the source of the bias? So it's all very well to know that we are subject to this bias, but what are the sources of the bias, and how do they develop? And so the theory behind this is that these biases are a product of our evolutionary history. And so the thing about evolution is that you can think of yourself as an organism designed to perpetuate itself over a long period of time. And so you need to survive in the period. So you need to survive in the environment for a certain period, reproduce, and then your species carries on. So in thinking about this, there's a famous article which is Masaru Todo, he's a Japanese theorist, and this is a classic in artificial intelligence. And he talked about a fungus eater, a model of human behavior in an unsophisticated environment. So to decide for him to help people identify the kinds of biases and heuristics, shortcuts we might have, he said, why don't we think about this model? You've got a fungus eater who survives on fungus, and it's got limited brain power and limited energy. So the fungus eater then has to make decisions and has limited information processing. How does it survive in this fairly uncomplicated environment? And it survives by making these shortcuts. So by learning over a period of time, it realizes that there are certain shortcuts that help it to survive. So, as I said, if X, then Y. So in the same way, David Hirschleifer, and this is a text, a reading that is required in this, because I can't go through all of the examples and all of the theory, but this certainly it gives you a good background. So I'll be assuming you've read this in your exam. But he posits that people's behavior basically stems from three types of evolutionary adaptations, or adaptation mechanisms. So one of this is this heuristic simplification, this what I'm talking about, use of shortcuts. So if you go to if you go to Cottesloe, and then you look over to Rottnest Island, some days it'll appear really close, some days it'll appear really far and quite small. On a hazy day, it appears far and quite small. On a bright, clear day, it looks large and quite close. That's because your brain is making this connection that if it's clear and really sharply defined, the object must be closer and bigger than it is, and must appear somewhat bigger. It's obviously one of a suite of different, it's not the only rule that it uses, but it's certainly one of them, which is why you get this apparent discrepancy in how big Rottnest is and how close it is to you. So, and I'll go through some examples of this. Self-deception. So this might be a bit odd, but it turns out that by systematically deceiving ourselves, perhaps being over-optimistic in some situations, it increases the group's chances of survival. And then the third kind of is emotional commitment. In order to, so typically we live in a social environment, and in a social environment you make commitments to other people, and the effectiveness of those commitments, the effectiveness of those negotiations you have with other people will depend on how credibly you can convince them that you're committed to that. So sometimes if you're a rational person, that actually acts against you, because people will be able to calculate, will be able to predict your behavior by simply calculating the odds and saying, well, he will behave in this way because this is the way that they benefit, and then they can take advantage of that. So if you want to credibly commit to some way, you can say, no, I'm just going to behave in this way regardless of what people, of the outcomes. And if you can convince people of that, then they'll think, oh, okay, better not mess with this person here. I'll show you a context in which that works. So let's go through some examples of this. I'll try to move to them fairly quickly, so I can get through, I won't be able to get through all of the slides, but I'll try to get through most. The representative heuristic is this notion that if something fits our idea of the idea of an object, then they must belong to that category of person. So here we have Mary is quiet, studious, concerned with social issues. While an undergraduate at UWA, she majored in English literature and environmental studies. So which of the following three cases is most probable? Mary is a librarian. Mary is a librarian and a member of the Greens Party. Mary works in the banking industry. Now, my guess is that you wouldn't be shocked if we said that Mary is a librarian and a member of the Greens Party, right? You think, yeah, that's the kind of person that you expect. But on the other hand, which is more probable, A or B? A is more probable because there's only one condition to fulfill. Whilst many librarians are members of the Green Party, many librarians also aren't. That's only one condition. So A is more probable than B. But what about C? Mary works in the banking industry. The fact is, Mary mightn't give you the kind of person who works in the banking industry isn't the kind of person who describes Mary, at least in those dimensions. However, 3 is the most likely scenario, simply because there just aren't that many jobs as librarians. There are many more jobs as in the banking sector. So a whole lot of people work in the banking sector who'd rather be librarians or rather be anything else, almost, but they happen to work in the banking sector because that's where the jobs are. So the representative heuristic, which works well most of the time but can be misleading, is when we look at how much the hypothesis resembles. So we look at librarians and think, oh, this person must be a librarian because all librarians look like that, whereas in fact lots of librarians might look like that, but all the people who look like that, a majority of them probably work outside the library. A majority of them might work in the banking sector. So people will often confuse a good company with a good investment. Now, why isn't a good company a good investment? Or may not be a good investment? So we can agree that, say, Microsoft is a good company, but not be a good investment, simply because it's already overpriced. That's one very good reason. So in fact, a good investment might be a bad company, because a bad company is not very profitable, but it might be way underpriced, even given its... So people might write it off completely, and in fact it's got more value than its price indicates. So a bad company can, in fact, be a good investment. Preference for familiarity. Again, people have more confidence in things with which they're familiar. So when you're investing, you're more likely to invest in a WA company than you are in an Eastern States company, simply because you think that there's a WA company, you know it, you see it's around you, you see evidence of it, it seems more trustworthy. A few years back, around 2012, there was a competition for a stock picking competition, and all of the people from WA won. The teams from WA did much better than the teams from the Eastern States. Why? Because they picked WA companies, and WA companies happen to be in the middle of a mining boom, which is why they did well. So this preference on familiarity, if you tell a story by someone who's part of it, is viewed as more credible than someone from the outside. So we had a speaker for the Fawa breakfast the other day who was someone who told her life Sumich is I forget it's Carl Simic, who was from Sandfire Resources. Give an excellent account, but partly a lot more credible and believable because he was familiar to us. He spoke about things that companies that we could relate to. The anchoring and adjustment heuristic. What's the proportion of African countries in the United Nations? Greater or less than 5%? Well, is it greater or less than 5%? Is the population of Greece greater or less than 20 million? And what's the population of Indonesia? Now, you might think the population of African countries is greater than 5%, and you might think, oh, maybe 12%? 30%? It turns out to be about 25 to 30%. But you wouldn't have adjusted that much. This simulate the population of Greece, is it greater or less than 20 million? Now, a few years back, just after the Olympic Games, this was in 2004, I thought, it must be about 50 million, because I was seeing Greeks everywhere. There were, and then there were lots of Greek people of Greek origin in Perth, and many more in Melbourne. And so I think, there must be lots of them. But it turns out it's only 15 million. The population of Indonesia. You probably know it's more than 25 million because Indonesia is bigger than Australia. But by putting 25 million down, you sort of start off with, okay, maybe 50 million, double, or triple, 75 million. It's 265 million. So the point here is that, and this is quite a remarkable thing, any number that you set out, you will anchor on this and then make an adjustment, even if it's completely unrelated. So it has some things about negotiations. When you're negotiating with a group, people often say it's better to go last. It's not. It's better to go first, and you set the terms of the negotiation. So if you're a union and you're setting the terms for, you're doing enterprise bargaining, you'll say, yep, we want, you start off and saying, we want double the raise for our members, so we want 8 weeks of holidays rather than 4. And it's completely off the wall. That's called an ambit claim. And you think, what's the point of that? It's absurd. They're not even being reasonable. They're not being reasonable, but what they're relying on is you'll adjust downwards, but when you're adjusting downwards, the other side will adjust not all the way down. They'll adjust quite dramatically, but not all the way down. So you're more likely to get away with a higher adjustment. So when you're going for a raise the first time, you say, can you raise me 10%? Don't go with that. Go with, can you give me a raise of 40%? No, 100%, whatever. If you go, but and then they'll say, oh no, we can't give you that. But we might give you 20%. Are you going to be happy? So, yay! I'd be happy with 10%. I'm happy for a job, but the point being, that's the. So the adjustment is often insufficient. Now this might seem like a fun thing to do, but it actually has some real consequences. So let's talk about one consequences where it's playing out, I think, now. You have Wesfarmers. They've bid $2.25 for Lynas Corporation. The highest price reached by Lynas was $2.89 per share in May 2008. Now, if you're a shareholder in Lynas, this figure, the figure, the 12-month high, is reported everywhere. So it's not hard to find. So you look at that, and they're thinking, is this a good price? $2.25? Less than 12 months ago, we had $2.89. Wesfarmers is being opportunistic. They're just getting us when we're down. So no way that we should give in to them. So this is, I was talking to Wesfarmers, a person who actually worked on this deal, and he said, look, and I told him about the bias, and he said, yeah, but the circumstances have changed, and it's true, the circumstances have changed, so the company's worth much less. But try convincing the shareholders of that, it's quite different. they're anchoring on this 12-month high. So which is not to say that takeover won't go ahead, but they'll face a much more difficult task persuading people that this is a fair deal because they're anchoring on this $2.89 share price. Again, people are more inclined to believe a statement when it comes in the form of information that's easy to process. And this is true. This has got to be something that people can understand. Diet pills, or television campaigns, order products. A couple of years ago, there was this. There was a product that was sold. You had to put a tablet in your petrol tank. So this was when petrol prices were high. And I think it was called Firepower or something. And you put the product in your petrol tank and that would increase the efficiency. Something that people can understand. It works like, you can relate to this. You have a Berocca, you're feeling bad, you have a Berocca, makes you feel good. So similarly, can't be that different. You put something in your tank, increases the efficiency of petrol, your car goes faster and longer. So that's what's known as, that kind of a thing is known as an elevator pitch. You want to have a business model. This is an American. Over here we might call it a lift pitch. When you get into the lift, the time between you get from the bottom to the top floor, you need to be able to persuade the person about what you're doing, why it's attractive. So, and it's a true thing. The simpler you can make your business model, the more likely it'll be plausible to people who you pitch it to. So when people judge the probability of an event, people often reach back to the most recent examples and underweight earlier examples. So when you're picking a stock, people tend to pick items that appeared in the news. This explained around 50% of portfolio selection. Richard Sloan is a student who sat where you are sitting a couple of decades back, and he went on to become Managing Director, Equity Research, Barclays Global Investor, and an eminent professor. And he's done lots of research, and one of the things he's found out is that investor recognition of a firm's stock can be explained by the extent to which it's in the public's eye. When you're in the public's eye, you become familiar. So one reason why Apple is doing so well is because it's in the public eye. But he finds that, so this is based on, investors can only use securities that they know about in constructing their optimal portfolio. So to invest in something, you need to know about it. So what they find is that to the extent that something becomes in the public eye, so as it increases in salience, it becomes reflected in the share price. Demand for it increases and the share price goes up. As time passes and it fades from the public eye, then investor demand falls away and it drops. So future stock returns are negatively related to changes in investor recognition. So what I mean by this is, if there's an increase in investor recognition now, it'll go up in price, but in future, as the investor recognition declines, it reverses. This illusion of control is the tendency for people to overestimate their ability to control events. And here is boys tend to be overconfident than girls in a variety of contexts. This is an interesting one. Why would this be the case? And again, there's an evolution explanation for this. So think about a situation where there's a village. So you're in a village and in a forest. So this is a couple of thousands years back. And there are these animals outside. And pretty soon they're threatening. They're going to invade and eat everyone in the village. So we need to send someone out there to defend. It's not 100% sure that people will succeed in beating off the beasts, but you've got to send out your best force. So your strongest, most capable members of the village would be your men between 18 and 22. But if you're 18 and 22 and you're pretty smart, this isn't all that attractive because there's a good chance you'll be killed. So you try to hide and you try to push another person in front of you, the other 18-year-old, not him, no, not him, got a leg, sort of things. So that's not helpful. So you need some indication. So what might be helpful is to give these particular group of members of this village an extra dose of confidence that might be justified, but they think, I can do this. Danger, no, nothing, I can do this. So they self-select. They think, yeah, pick me, and let me go out and fight the beasts. And there you have it. There's a nice, no, the village might not survive, they might be ineffective or whatever, but the point being, they've got the incentives to go out and... So there's a rational basis for overconfidence in that. That might be why overconfidence has evolved, to make people take risks. And we find that boys being in the context of stock trading isn't so good, because they tend to be overconfident, unjustifiably about this is not the beast, this is where you get eaten up by the market. Has anyone been to Korea lately? No one? Okay. I was going to say, has anyone experienced the internet in Korea? Although it'd be difficult if you haven't been to Korea. There. Anyone familiar with K-pop? Okay. In Korea, it turns out they have excellent internet, really, really fast. So whenever you travel everywhere, you can have access to super fast internet. And it puts ours to shame over here. But one of the consequences is that there's a lot more people trading online. And because they're trading online, they're going online, they're getting a lot more information, and they become more confident of their abilities. And so they trade more and they lose more. And this is the consequences. You trade, you win, and then the part of the brain that gets stimulated is the same part that cocaine stimulates. So you get addicted into this cycle. So mental accounting is this another heuristic where people, you can see what's wrong with this. They're saving 15,000, they have 15,000 in the bank, they're earning 10%. They bought a new car, which they financed with a 3-year car loan. What's wrong with this picture? It doesn't make sense. There should be the money, they're paying tax on the 10%, and they're paying for the car loan with interest on an after-tax basis. So they're better off. But of course, they're using two different mental accounts. For a similar situation over here, Mr. S admires a jacket. He doesn't buy it because it's too extravagant. On the other hand, he receives a present from his wife and he's happy. And he's really happy. It's not like he's faking it. He's really happy. But it's the same account. People are overconfident in their judgments. So they have systematic planning fallacies. They predict tasks such as writing assignments, writing lectures, everything. That is, they underestimate the time taken. So what I want to show you here is this. I think I've made this point already, but it turns out that depressives evaluate situations much more accurately than, as I say, normals, as they're called them in this paper. So being a depressive means that you might see the world and calculate the odds of success more accurately. But in doing so, you are painting a picture that's less rosy, and you're making yourself feel depressed, and you get unmotivated. So normal people tend to think everyone thinks that they're great, or more great. Non-depressives underestimate the amount of negative feedback they've received, and non-depressive overestimate the predictability and control they have over positive outcomes and underestimate the predictability of the undesired outcomes. But this has the benefit that it makes them feel better, more optimistic about trying things. So there's the positive outcome. You take risks. The next category I want to talk about is this emotional overriding of reason. Should you always be sensible? And sometimes not being sensible can pay off. As I said, if you're sensible, you're conceding a tactical advantage to others, because if you're sensible and you do things according to the odds of winning, then the other people can make a similar kind of calculations. So an instance where this might pay off. So what this says over here is every generation gets the beach villain that it deserves. This is from the New York Times, and it's a feature article on a tech billionaire, Vinod Khosla, who's aggressive, shameless, obsessive, and optimistic. So what he's done is, now think about this, the guy's made $1 billion, you think he'd be sensible, reasonable, calculate the odds. He's been fighting in court to keep the public off a piece of beach that adjoins his property on the Pacific coast. Now, if you really would like this beach, this might make some sense. But it turns out he bought the place on a whim, he's never spent a single night there, and he regrets it enormously. But to keep the public off on this point of principle, he's willing to litigate this for the rest of his life and has about $3 billion to spend on it. Now you might think, why? And the whole of California is against him because public access in California is a big thing, like it is over here. So this doesn't make sense, you might think. And what would his business partners think? He's spending his money here. But it could actually be a tactical thing. I don't think actually he meant this way, but it's turned out to be quite a good thing. Because hasn't been a problem in the office. His partner says, it's an incredible negotiating tool for me. Someone comes in, they're bargaining, they want to play hardball. He says, you want to play hardball with us? You trying to be tough with us? You don't think we'll fight this? He says, when the company's trying to screw the firm, he simply brings up articles on Google about the beach at a meeting. And he says, my boss is going to the Supreme Court for a beach he's never gone to. He's fighting about something he doesn't really care about, and he's willing to spend hundreds of millions of dollars on it. Now, you want to fight about this? And says he just sits there. And then they decide, no, it's not worth it. Let's start negotiating. So that's the kind of thing. When people get angry, sometimes and they lose control. That could be nature's way of sort of providing some credible commitment. Of course, most often that might work in the wild. It often doesn't work in the more civilized life. So I'd use that cautiously. So can we and should we control our biases? If so, how? Daniel Kahneman, this person invented the field, and he says he's still prone to these biases. His overconfidence, he makes extreme predictions, he underestimates how long it'll take to complete a task, and he says he hasn't improved since he started on these studies. The other, and this is a study I put in the readings, actually some of these biases are actually ingrained. So people who are traders, good traders, over time seem to be able to learn to control these kind of biases. So you and I might see the top line as being the biggest, but it turns out that the people in the sand forages of the Kalahari are more likely to see the lines as they are equal in length. And that's because they're growing up in an environment where they don't have straight lines. It's all nature things, so they don't have this So this is where I stop this. I seem to be more efficient in the morning class, so I'll go on a bit, until 4:30. One analogy here I want you to draw in terms of dealing with this bias is if you recognize where they are, you can take action to prevent what's happening. And an ancient example of this is from the myth of Ulysses and the Sirens. So Ulysses was going back with the Argonauts and back home. But then he'd heard about this group of creatures called the Sirens. The sirens were famous for singing very alluring songs. So that's where the term a siren call would come from. And they would be very attractive. So sailors would hear this, would be attracted, and would go towards the island where they would founder on the shore. So their ships would be wrecked on the rocks, and then they're plundered. So that's why I have to resist the siren call. So Ulysses had heard this. So he wanted to hear, though. He wanted to benefit from hearing them. So what he did is he put wax in the ears of all his oarsmen. He tied himself up, and he said, whatever, if in case the wax falls out, whatever, don't listen to me, but I'll keep my ears open and I'll be able to hear them. So when he hears them, he can't do anything because he's tied up. So that's the kind of thing you need to do. You need to be able to abstract yourself from that situation. Probably a better example is this one, the Stanford marshmallow experiment. This is a famous experiment whereby 5-year-olds were given a choice. They were told, here's a marshmallow, I'm going to leave the room. If you don't eat it, if you eat it, that's fine. But if you don't eat it, you'll have another marshmallow. And so the trick is now to sort of stay there in the room with this marshmallow and control yourself until the experimenter comes back. What they found out is that the people, and there's some updates on the study, so you can look it up, but they found out that the people who didn't eat the marshmallow turned out to have much greater success in life because they were able to control themselves. They're able to resist temptation, basically. Now, the twist is, this wasn't an innate thing. The way they were able to resist, every 5-year-old apparently likes marshmallows. But the ones who didn't eat it, didn't just stare at it, waiting. They looked around, they strummed, they stared at everything, but they may hum to themselves, and effectively took away themselves from the situation. So that's the kind of thing you need to do. Acknowledge that you're going to be prey to this, and then try to take steps to mitigate its effect, rather than simply use your raw willpower. So this way, is the knowledge of psychology useful in investing? He says, yes, but then this is where the Cassandra learning effect, Cassandra was a prophet who was told, the curse was that she would tell things that were true, but no one would believe it. And so similar kind of things where you're told something is, and you think, it's true for everyone else, but it's not me. I have enough self-control. I can do this. Okay. Last thing is understanding the world to provide a basis for identifying the scope of behavioral and neoclassical models. So this person says, longer-term success will always be driven by spending wisely, operating efficiently, and doing things better than competitors. So what news is this? Water is wet. I mean, it's not the kind of... This is the same. It's not telling you anything. And he says, markets are driven very significantly by emotion, and people generally invest too much with their hearts and not enough with their heads. So that's not much. But and so this is a point made by someone says, this is all very well. It's anecdotal stories, but, it's very interesting. It fills the conference very well. So people get entertained, they laugh, they things. But then ultimately, we need to know how to apply this. So there's this, to give you an example of what it means by this, an empty explanation, you have the economic psychology of stock market bubbles in China. So researchers have looked at China, and they say that there are 3 psychological factors: greed, envy, and speculation, and the burst of the bubble to 3 contrasting factors: fear, lack of confidence, and disappointments. They said only after Chinese companies become really commercialized and profitable and investors become rational can the stock markets become stable. This is complete rubbish. There's no reason why people in China are any more subject to greed, envy, and speculation than anyone else. So this is a kind of empty explanation in talking about saying that the markets go up and down in China because of greed and fear. is the same as saying the stock market's go up anywhere else in terms of greed and fear. It just doesn't make, it's not an explanation. It's like saying opium causes people to go to sleep because of its dormitive power. So, opium, so how would this, if you know that market prices are determined by investors acting, how would this affect your investments? Would it be easier to make profitable investments? Are you so different from the crowd that you could outsmart it? So this is the neoclassical critique of behavioral finance. They're saying that actually the theory works well, it's not broken, and individual behavior is irrelevant, and the markets, in the aggregate, markets are efficient. So if not smart investors arbitrage away the inefficiencies. And so they say, we don't have a coherent theory that allows precise predictions. Every time someone fails, we'll make up a different story about it because it's due to some different kind of emotion. But the behavioral critique of neoclassical finance is different. What they say is, well, market prices are often unbiased and efficient, so markets do work, but on some occasions, the prices can diverge from fundamental value, and this is where behavioral finance can explain these biases. And because there are limits to arbitrage, that is, markets can remain inefficient for longer than investors can remain solvent, these inefficiencies can persist. So, for example, if you know that the housing is overpriced, there's no obvious way to take advantage of overpriced housing to be able to bring down the market, to short sell. You can't short sell houses. So houses might be overpriced, if they are indeed overpriced. So this is the point. Basically, the noise investors can outnumber the smart investors so that the prices don't inevitably move to their true value. So how significant are deviations from fundamental value due to limits to arbitrage? So in 1998, we found that large corporations were trading at their highest market values. A lot of people said they were overvalued, but other people said they weren't overvalued. This is justified by the facts. So you had two different interpretations. So the point here is, if you really believed at the beginning of 1998 that the market is overvalued and you sold short, you would have lost 28.6% by the end of the year. If you sold short earlier, the next year you would have lost 33%. So, point here being the limits to arbitrage. The markets can be inefficient for longer than someone can remain solvent. Okay. So making use of behavioral finance, like you can read that yourself. I'll go to the quiz. And the quiz is AMOS, A-M-O-S.